Hi everyone, this is Rob Roy and welcome to the Elliott Elite U.S. Market Update. Apologize for the late posting of this update for last week. My father has been battling an illness for a number of years and took a significant downward turn recently. I've been spending a great deal of time with him, so this will not be a common occurrence. But let's get caught up with what happened in last week's market. We are continuing to power higher, as you can see, with a very vertical move in the SPX, the S&P 500 cash index. Put our Elliott wave labeling back on, and you can see that we are still in that very strong wave 3. Let's go over to the SPY so that we can bring volume into the mix. And one thing that you want to note is, as we've been moving to the upside, look how the volume has increased. I mean, we've been having decent volume. We've been talking about that. We've had low volume for so many years. I mean, literally years. And now we've got a good period of time with above average volume. And then especially over the past week or two, with every day being significantly over the 200-day moving average in volume. So pretty significant volume behind this move. And on one blush, you would think, well, that means that everybody's buying. It's an extremely strong move to the upside, as indicated by the wave 3, and the volume backing it up means that we're going to continue this move for quite a while. And maybe that is true, and it is always good to have volume backing a move, but not this much volume. When you have this much volume, there has to be a mixture in there of buying and selling, or there likely is. Typically, the volume is greater on the downside than on the upside. And when you're going through an accumulation phase in a market or an individual security, usually you have just above average volume, kind of like what we were doing back here in December, where we were just above a few spikes there, but hovering around the just above average volume. And now we're getting a little bit more volume into that. And this is also indicated by the VIX. So we're starting to see some increased volatility, and that gives you a hint that there's some selling going on in there as well. The smart money always gets out first, and that may be what's going on. And as we've talked about in these Elliott wave patterns, we also have the Elliott wave corrective patterns that we've been spending a great deal of time talking about, because I think it's tremendously important for you to add that to your Elliott wave education. And you can see that we have a little triangle here in the VIX. So we've bottomed out down here around 9. We've moved to the upside. We had a spike higher, and then we've gone into a symmetrical triangle. Now we could break either direction, and we've risen just enough in the VIX to where there is still the possibility that we break out of this triangle to the downside. Remember, with a triangle, you don't want to guess what direction the breakout's going to be, because by rule, when you have one of these Elliott corrective triangles, you can break either way. And you want to always make sure that you leave or you put on a position that allows you to profit regardless of the direction of the breakout. Don't get caught trying to pick direction on the breakout because the market tends to like to make fools out of us when we do things like that. When we violate the rules, it usually comes back to bite us. So I wanted to show you that, and with this elevated volatility, that coincides with this increased volume. So what I'm trying to say is that even though we're having a very strong move to the upside, likely a lot of heavy buying in there, but there's also some people that are lightening up on positions, I believe, as evidenced by the VIX. So just something for you to think about. I want to add another indicator that we're going to continue to watch, because we've talked about all the different things that could derail this market rally, black swans, etc. But the number one enemy to an equity market is interest rates. And a lot of people are watching the 10-year note in the U.S., and if it approaches 3%, that's going to send some shock waves through the market, and that in itself could end up derailing the rally, because as I mentioned, that is the number one enemy. So let's take a look at this chart, and we'll put our Elliott wave indicator on here as well to see where we're going to go. Then I also want to do something that we haven't done much of lately in the last couple of postings, and we'll get to that in just a second. But let's go ahead and condense the chart a little bit. Again, the ease of using this program is amazing. It just expand and contract is so much easier than any of the other ones I've ever used in the past. But if we take a look here, this is extremely important level of resistance, and note that we just broke above it, and then in classic style we break above support or resistance area, so we break above it and then we hover in that area. So we're testing the breakout, and then the question becomes, does this breakout hold? And we tick off to the upside. Not good for the equities markets, but good for financial stocks, but that's about it. And then, or is the alternative that we can't hold the breakout and we fall back down. But you can see going all the way back to 2016, that's been an area of resistance for the 10-year, and since we broke above that, I wanted to share that with you. So let me take this off and spread the chart back out and put our Elliott wave indicator on here, and you can see that we're in a wave 3 with interest rates as well. Now that just will not last forever. Can it happen for a short period of time where you have a strong move higher in interest rates with a strong move in the equities markets? Yeah, obviously, because we're going through it right now. But it will not last. It doesn't last. It doesn't work that way. One of these is going to have to give. Either the equity market's going to give or interest rates are going to give. But we're not going to continue to power higher with both. It just historically doesn't work that way for the markets. Now remember, another thing that I wanted to point out is I've had people over the years get confused by this 4 right here. Talked about this prior, but I think it's important to bring it up again. Some people think that when it shows this 4 here with the wave 3, that it's forecasting that we're going to move down now to the wave 4, like the wave 3 is over and we're going to start the correction. That's not what this means. What this means is if the wave 3 were to end now, this is where the targeted 4 would be. So again, this 4 here is not forecasting the end of the 3. It's just telling you if the 3 were to end now, that's approximately where the 4 would be. So don't get confused with that and give up on wave 3s. I know a lot of people don't talk about trading the wave 3, and you know we do, because we bring in further indicators within Elliott wave that help us support that, and that's why we feel that we can trade and identify opportunities within the wave 3 as well. It's the strongest wave, so why wouldn't we want to? So that's the type of education that we want to provide for you in your Elliott wave continued education. Now, one thing that we hadn't done much of that I brought up that I wanted to do was to go to a weekly chart. So let's take a look at a weekly chart here of interest rates, and we see something very interesting. Note that we have a really nice 5-wave Elliott wave pattern in the interest rates on the weekly chart as well. And we've got a perfect 50% retracement. I mean, that's about as classic as it gets. And so far, we've extended roughly 64%. So where are we going to go from here for the top of the wave 5? Well, let's use our Elliott extension tool. So it'll give us a target. And you can see that that's right where we are, right there around that 62% extension, 64 on the chart to be exact. And so we're going to have a potential high on the wave 5 up around 32. We're only down around 27, 28, so that's a significant move higher from here in interest rates, and in my opinion, that would be enough to cause some jitteriness, I guess I should say, in the markets, some unease, some increased volatility for sure. So we'll see how that plays out as the interest rate move in this pattern continues. So we've got the target there of 32 on the wave 5 on the weekly chart, and then we go back into the daily chart, and we're in the wave 3, and those are confirming. Sometimes people get confused as well when they think, okay, go check the weekly chart, because that's what Elliott told us to do. Always take a look at the longer time frame and see if you're getting corroborating information or conflicting information. And here we're getting both telling us that there is more room to move to the upside. We're in a wave 3, which is obviously an upward move, and we also are in a wave 5 on the weekly chart, which hasn't reached a potential 100% extension yet, which would be the target on a 50% correction. So those two things are telling us that interest rates could go higher, another warning sign for the markets, and that could be why that there is some smart money starting to sneak its way out here, even as the market continues to rally higher. I mean, there's just been no shortage of media coverage of this market rally, and it really is bringing in the fund flows are off the charts of money coming into ETFs and other vehicles like that into the equity markets. And that means that we are getting the retail traders' money in, and the retail traders, as we know, as we've learned, they're always last to the party, and usually by the time they come in, the biggest part of the move, and sometimes the majority of the move, is over, and they're the ones left holding the bag as the smart money gets out. Is that what's going on? I think it might be. So we'll keep an eye on that as things move through the next couple of weeks. So I did want to update you and educate you on this TNX that we'll be looking at. So some of the other charts that we've brought up, Altria, we're still in this pattern here where we made the wave 4 at a 49% correction. Really, it was kind of just the one day, and you might say, well, that's not really qualified as a correction, but remember that that's just a little bit lower than where we were here, where we had a good solid foundation here for the correction. So it tried to break it, it couldn't hold it, and moved back to the upside. That's actually a sign that we're likely to continue higher from here and run up to the wave 5 target due to the fact that tried to break below there and couldn't, and then we recovered again for a higher close the very next day. That's all bullish action in Elliott wave technical trading. So the STZ, we talked about last week about how we had this triangle. Again, the Elliott wave corrective pattern, flat zigzags and triangles, this triangle, and we did break out of the triangle. Now the interesting thing is what happens when we get to closing this gap. It's not a huge triangle, so it wasn't forecasting a very big move. Remember, the breakout is approximately the width of the mouth of the triangle. So it isn't that big of a breakout move, and we are going to run into a little bit of resistance once that gap gets closed or filled. So then we'll see what happens with that. So next week is going to be very interesting to see if this continues on and we move higher into the potential extended wave 5, because remember, this wave 5 has already done its thing. So we're just looking to see if we get an extended wave 5 out of this. It's already fulfilled its obligations from an Elliott wave standpoint. And then we also brought in CDW last week because of all the different Elliott wave patterns. If you haven't watched that recording, go back and watch it because it's fascinating. There's so many different things going on from an Elliott wave standpoint within this one chart pattern that made it look like it was going to go higher, and it's gone just a little bit higher. Just as a refresher, our target is 78 based on all the things that we looked at in last week's recording, so we're not too far away. That's just around here, and so we'll see if that carries through. But remember what we were talking about last week is the fact that when you have more than one Elliott wave pattern within an overall chart, then that puts the percentages higher in our favor. Still doesn't guarantee anything, but it puts the percentages higher in our favor. So next week's report is going to be fascinating to see how some of these things play out that are starting to get kind of close, and also see what happens with interest rates if they can continue to move to the upside. So hope you enjoyed a wonderful weekend, and we'll be back to talk to you again next week. Take care, everybody.